Silicon Valley Bank collapsed on March 10, 2023, after a run on deposits drove the Northern California institution into insolvency, marking the largest bank failure since the financial crisis. Was it a house of cards waiting to collapse or an established bank who took on too much risk in order to show growth to shareholders? SVB was shut down by the Federal Deposit Insurance Corporation, which transferred its deposits to a new entity called New SVB Bank in order to protect consumers. The FDIC estimates that the bank's failure will cost its deposit insurance fund $8.6 billion. The FDIC is looking for a buyer for the bank's assets and liabilities, but it may not find one willing to take on the bank's risky debt portfolio. Some sources suggest that the Federal Reserve could step in and buy the bank's debt to prevent a wider banking crisis, but this has not been confirmed by the Fed or the Treasury. The bank's debt holders could also face significant losses if the bank is wound up. Moody's said up to a fifth of SVB's uninsured deposits may not be recovered if the bank is wound up. The bank's collapse also means that startups and venture capitalists who had accounts or loans with SVB could face billions in losses. Silicon Valley Bank had a large and diverse client base, including some of the biggest names in consumer tech, biotech, fintech and venture capital. According to one report, here are several known companies who have accounts with Silicon Valley Bank: Airbnb, Cisco, Vox Media, Pinterest, Square, Stripe, Uber, DoorDash, Instacart, Robinhood, Moderna, Pfizer, BioNTech, Novax, Sequoia Capital, Andreessen Horowitz, Benchmark Capital, Kleiner Perkins, Roku, Roblox, Etsy. These companies may face cash crunches, losses or delays in accessing their funds due to the bank's collapse. Some of the crypto companies that revealed their exposure to SVB include Coinbase, Kraken, Gemini and Pantera Capital. These companies had accounts with SVB for fiat currency transactions or custody services, and some of them also received funding from SVB's venture arm. SVB's failure was triggered by its heavy exposure to crypto assets, which suffered a massive crash in February 2023 due to regulatory crackdowns and hacking incidents. SVB had invested more than $10 billion in crypto-related companies and projects, such as BlockFi, Coinbase, Circle and Ripple. It also offered crypto custody and lending services to its clients. Their crypto portfolio lost more than 80% of its value in a matter of weeks, wiping out its capital and liquidity reserves. The collapse set off a blame game in the tech industry, as executives and investors jumped on the crisis for their own messaging. Some blamed the bank for being too reckless and greedy with crypto investments, while others blamed the regulators for being too harsh and slow with crypto rules. SVB's collapse also impacted many startups and venture capitalists who relied on its services and funding. Some faced delays or disruptions in their payments and transactions, while others faced uncertainty about their future financing options. Other banks could also fail if they have similar exposure to crypto assets, or if they face a run on deposits by panicked customers. Silicon Valley Bank's CEO Greg Becker sold $3.6 million of company stock under a trading plan less than 2 weeks before the bank disclosed extensive losses that led to its failure. He also cashed out stock and options for a $2.27 million net gain in the weeks before Friday's collapse. This raised suspicions that Becker was aware of the impending collapse of SVB and tried to cash out before it happened. Becker also faced criticism for his role in overseeing SVB's risky lending and investing practices that led to its downfall. He was accused of being too optimistic and complacent about SVB's financial position and failing to address its accounting issues and capital needs in time. Some analysts and investors called for his resignation or removal as CEO. This could raise questions about whether he had insider knowledge of the bank's troubles, or whether he violated any securities laws or fiduciary duties. The SEC has not commented on whether it is investigating Becker's stock sales. SVB sued insurers over $73 million lost to private equity CEOs fraud in February 2023. The lawsuit alleged that SVB was a victim of Elliott Smerling, a former CEO of a private equity firm called JES Global Capital Partners, who pleaded guilty to wire fraud and money laundering charges in 2022. Smerling had obtained loans from SVB by using fake financial statements and forged documents. Silicon Valley Bank, reported net income of $1.2 billion for the year 2022, an increase of 17% from 2021. The company also reported total assets of $212 billion, total loans of $74 billion, and total client funds of $342 billion as of December 31, 2022. However, a short seller named William Martin predicted SVB's blow-up 2 months before it happened on Twitter. He pointed out several red flags in SVB's financial statements, such as a high exposure to stressed venture capital and private equity sectors, which accounted for 63% of SVB's loan portfolio and 75% of its deposits as of September 30, 2022. A low provision for loan losses, which was only 0.18% of total loans as of September 30, 2022, compared to an industry average of 1.5%. This suggested that SVB was underestimating its credit risk and potential losses. A high reliance on non-interest-bearing deposits, which made up 54% of SVB's total deposits as of September 30, 2022. These deposits were not insured by the FDIC and could be withdrawn at any time by SVB's clients. A low capital ratio, which was only 9.8% as of September 30, 2022, compared to an industry average of 12%. This meant that SVB had less cushion to absorb losses and meet regulatory requirements. These trends suggest that SVB was facing increasing financial stress and liquidity risk due to its exposure to volatile and risky sectors. The bank may have also been hiding or ignoring its true financial condition and engaging in insider trading before its failure. SVB's CEO Greg Becker was not the only one who cashed out of their stocks before the collapse. SVB CFO Daniel Beck also sold $1.9 million worth of shares on February 27, just 2 weeks before the bank's failure. Both Becker and Beck sold their shares under a legal corporate trading plan established by the SEC to prevent insider trading, but it is unclear if they had any prior knowledge of the bank's impending doom. Interestingly, this is not the first time that SVB has been involved in insider trading allegations. In 2021, a former SVB vice president named Moni Gad was convicted of insider trading and securities fraud for using confidential information about SVB's clients to make illegal trades. He was also charged with tampering, identity theft and criminal contempt for forging several character references to get a lighter sentence. There are some other controversial decisions that SVB made recently that contributed to its collapse. Here are some of them. SVB invested heavily in risky bonds that lost value as interest rates rose and inflation spiked. The bank also failed to hedge its exposure to these bonds, leaving it vulnerable to market fluctuations. SVB relied too much on deposits from startup companies and venture capitalists, who were its main clients. When these depositors lost confidence in SVB's financial stability and withdrew their money en masse, the bank faced a liquidity crisis and could not meet its obligations. SVB was involved in a lawsuit with a former client, Rothenberg Ventures, who accused the bank of transferring $25 million to a wrong account and damaging his reputation. The lawsuit was settled out of court in 2020, but it raised questions about SVB's internal controls and compliance. They also faced several scandals since 2000 that tarnished its reputation and weakened its financial position. Here are some of them. In 2002, the bank agreed to pay $4.5 million to settle charges by the Securities and Exchange Commission that it violated securities laws by making improper loans to executives of public companies. In 2006, the bank was sued by a former employee who alleged that he was fired for blowing the whistle on fraudulent accounting practices at the bank. In 2010, the bank paid $30 million to settle a class action lawsuit by shareholders who accused it of misleading them about its exposure to subprime mortgages during the 2008 financial crisis. In 2015, the bank was fined $7 million by the Federal Reserve for violating anti-money laundering rules and failing to report suspicious transactions. In 2019, the bank was hit with a $250 million lawsuit by a group of investors who claimed that it conspired with Theranos, a fraudulent blood testing startup, to defraud them. In 2022, The bank admitted that it lost $1.2 billion in a cyber attack that compromised its systems and customer data. It also disclosed that it had invested heavily in cryptocurrencies and suffered huge losses when their prices crashed. In 2023, just before its collapse, the bank announced that it was under investigation by several federal agencies for possible violations of securities laws, consumer protection laws and tax laws. It also revealed that it had overstated its assets and understated its liabilities by billions of dollars. Jim Cramer touted the potential of SVB Financial, the parent company of Silicon Valley Bank, on his show, Mad Money, on February 8. He said that SVB was the 9th best performer in 2022 and praised its exposure to the tech sector and venture capital. He also said that SVB was a bank that's worth owning and a terrific way to play this market. However, his words did not age well, as SVB collapsed on March 10 due to massive losses on its bond holdings and liquidity problems. Many people on social media have criticized Cramer for his bad advice and mocked him for his lack of foresight. Some have even accused him of being part of a pump-and-dump scheme or having a conflict of interest with SVB. On the other hand, Cramer has defended himself by saying that he was not aware of SVB's troubles and that he was relying on its financial statements and analyst ratings. He also argued that SVB's failure could be a wake-up call for the Federal Reserve to stop raising interest rates and hurting the economy. Forbes magazine ranked SVB as a top bank just a few weeks before it collapsed. SVB was on Forbes America's Best Banks 2023 list, which was published on February 28. It ranked 20th out of 100 banks based on criteria such as return on average equity, net interest margin, efficiency ratio, and asset quality. SVB also made it to Forbes' inaugural Financial All-Stars list, which recognized 10 banks that had strong financial performance and customer satisfaction. However, these rankings did not reflect the underlying problems that SVB was facing, such as its exposure to risky bonds, its dependence on startup deposits, and its legal troubles. These problems became apparent only after the bank reported a huge loss for the fourth quarter of 2022. And faced a liquidity crisis due to a bank run by its depositors. It is possible that they relied on outdated or inaccurate data from SVB's financial statements and analyst ratings. It is also possible that they did not anticipate the sudden change in market conditions and customer behavior that triggered SVB's downfall. Some investors made money short-selling SVB. Short-selling is a strategy that involves borrowing a stock and selling it at a high price, hoping to buy it back later at a lower price and return it to the lender, pocketing the difference. One of the most famous investors who shorted SVB was Michael Burry, who was featured in the book and movie, The Big Short, for his bet against subprime mortgages during the 2008 financial crisis. He said that he had been warning about SVB's troubles for months and that he saw similarities between SVB and Enron, the scandal-hit energy firm that collapsed in 2001. He said that SVB was hiding its losses and liabilities with accounting tricks and that its business model was unsustainable. Another investor who profited from SVB's collapse was David Einhorn, who runs Greenlight Capital, a hedge fund known for its activist short positions. He said that he had been researching SVB for a long time and that he found many red flags in its financial statements, such as negative cash flow, high leverage, and low reserves. He also said that SVB was overvalued by the market and that its growth prospects were dimming due to rising competition and regulation. These investors were among the few who dared to bet against SVB, which was widely regarded as a successful and innovative bank by many analysts, customers, and media outlets. They faced criticism and ridicule from SVB supporters who accused them of being pessimistic, ignorant, or malicious. However, they were vindicated when SVB's stock price plunged from over $500 per share in January 2023 to less than $10 per share in March 2023 after its failure became public. It seems that SVB was both lying and hiding money in their earnings calls. SVB disclosed a potential fraud case tied to a $70 million loan in February 2021, which raised some doubts about its lending practices and risk controls. However, SVB did not reveal the full extent of its exposure to fraudulent activities by its clients, or itself until March 2023, when it announced that it intended to raise more than $2 billion to shore up its capital position. It also admitted that it had discovered material weaknesses in its internal controls over financial reporting and that it would restate some of its previous financial statements. Some of the ways that SVB was hiding money were by misclassifying loans as investments, overstating interest income, understating provision for credit losses, manipulating fair value measurements. These methods allowed SVB to inflate its assets and income while deflating its expenses and liabilities. However, these methods also made SVB more susceptible to market fluctuations and fraud detection. When market conditions worsened in early 2023 due to rising interest rates, inflation, and regulatory pressure, SVB faced a liquidity crunch as it could not sell or borrow against its illiquid assets such as startup loans or crypto holdings. It also faced a capital shortfall as it had to write down some of its assets due to impairment or fraud, or mark them down due to market decline. Some people may think that SVB was a house of cards, meaning that it was built on a weak foundation and collapsed easily. SVB had spent decades taking risky bets on startups that were not profitable or sustainable, especially in the tech and crypto sectors. SVB also had accounting issues and capital shortfalls that were not disclosed or addressed in time. When interest rates rose and market conditions worsened, SVB faced a liquidity crisis and a loss of confidence from its clients and investors. This led to a sudden run on the bank, and its share price plummeted by more than 90% in 2 days. Regulators had no choice but to shut down SVB and take over its assets on Friday, March 10, 2023.